firm. So we specialize in not-for-profit. So this team that I'm lucky to have with me here today all have a specialty, work with a lot of not-for-profits. I'm in the Toledo office. I work with clients all over the state. Amy and Danny are actually in our Columbus office, and they work with a variety of other clients throughout the state. And Tina is from our headquarters in Southfield. We've been fielding a lot of clients lately on these two hot topics really related to ERC and the shuttered venues from our clients and those individuals in our not-for-profit network. So Allison was really top of mind for us when we wanted to share information. So that's kind of how we got this ball rolling. As I think maybe if you mentioned this, Allison, this is being recorded, but just keep in mind that this information is fluid and it keeps changing day by day. And I'll turn it over to Amy in just a minute to be able to tell you about a quick legislative update that just happened, really over the weekend. But so just keep in mind that this information that's current. It's the best we know for right now. Hopefully, as we go through our conversation today, we'll be able to share information and you'll be able to glean where we're finding some of this information and get some familiarity with where to find the frequently asked questions documents that the federal government is putting out, so that you'll be able to see where to reference to get the information that you'll need. So with that, I'm going to get out of the way and turn it over to my other smart colleagues, and I'll turn it over to Amy to be able to give you a quick legislative update and tell you how we'll manage the questions.
Excellent. Thank you. And good morning, everyone. So we're going to save time for questions at the end. Please send those through the chat feature. I'll be organizing those for our experts, Tina and Danny. So submit at any point in time, and I'll get those to our experts. Again, reminder, stay on mute if you can. We also have a registration list. If you don't want any follow-up after this presentation, please email myself or Allison. We'll remove your name from that list. So before we get into the specifics of shuttered venue and employee retention credits, many of you may be aware that $1.9 trillion COVID relief legislation, it's called the American Rescue Plan Act of 2021. It was passed by the Senate this past Saturday, March 6th. The next step is for the House now to reconcile the Senate bill and then vote. And if that bill passes, then it heads to President Biden for signature. And this past weekend, people were actually predicting today was going to be the day of the House vote. Now it sounds like it's going to be tomorrow. And the hope is that legislation will be signed by President Biden by the week's end. So we'll see what happens. Again, it keeps changing every day. But a few highlights I want to point out if this does pass as is. There is proposed expansion of the employee retention credit. Tina will address that. There is additional funding for the Shuttered Venue Grant and allowance for organizations to apply for both the Shuttered Venue Grant and the Payroll Protection Program 2, or that PPP2, and that would be a huge favorable change if that goes through. The legislation also provides additional direct payments of up to $1,400 for individual taxpayers, $2,800 for married couples filing joint, and $1,400 for each qualifying child. There is a phase out. It starts at $75,000 adjusted gross income for single taxpayers and $150,000 for married taxpayers. And there's a lot of other items in the bill, but I want to highlight those items today. So we'll go ahead and dive in to Shuttered Venue Grants. And Danny, I think you're up, and I think you'll be sharing your screen as well.
Yeah, thank you, Amy. Go ahead and get this queued up. And can you see the screen, Amy?
Yes, yep.
Okay, excellent. All right, well, thank you, Amy. And thank you everyone for spending some time with us here today. I think Amy laid it out pretty well. And if there isn't a better example of the guidance changing lickety split and pretty much almost every day, it feels like, it would be just as we were preparing for the presentation. So we're working on the slides, putting together everything, and then the legislation passes through over on Saturday, Sunday, and then we're expecting to vote sometime this week. So we'll be going through the shuttered venue. We'll be talking about the employee retention credit. That's going to be the main focus today. We are going to acknowledge the PPP program, as Amy indicated. I think really when you're looking at the mechanisms and the support systems available for the not-for-profit entities, you really have to think holistically about all the programs that are out there. But with the shuttered venue and employee retention credit, we really wanted to home in on those and provide, at least as of now, the latest guidance. Sometimes it feels more like we're lawyers than accountants. We are still accountants though, so we did cite the IRS in our disclaimer. As Amy indicated, this information is as much as we could get as of yesterday when we had the slides done. And then I looked just this morning to see if there were any updates on the SBA website regarding any of the shuttered venue things. So no updates between the slides as of yesterday and today. But as Amy said, looks like there could be some legislation getting finalized later this week. So we'll provide you the information as it stands now. Amy gave you the context of where things are going, and then somewhere in between, there's probably plenty of questions. So our contact information is here. If you have any questions after the presentation, feel free to reach out to any one of us. I'll be speaking on the shuttered venue. Tina will be talking about the employee retention credits, and Amy and Kristen are happy to answer any questions as well. So let's start with the shuttered venue operator grants. So the legislation came out in the spring, and the Paycheck Protection Program was really the main impetus for funding and the main help that was available for not-for-profit entities. So then in the most recent funding that came out in December of 2020, there was the support for shuttered venue, and then there was clarification on the employee retention credits. So we'll talk a little bit about what the shuttered venue is, what kind of entities it applies to, a couple common FAQs, and then certainly we could speak for probably well over an hour on this topic. In fact, the FAQs are 21 pages. So there's plenty of information there. What we want to do today is just provide you high level key points. That way you can have enough information to say, hey, does it sound like our entity could benefit from this program? And then you can dig in a little further. So how much is available through the shuttered venue grant? Well, the amounts available are 45% of your 2019 gross earned revenue, or $10 million, whichever is less, as long as you were in operation as of January 1st, 2019. And you'll see we underline some terms throughout the presentation. The underline either signifies it's defined later, or it's just a really important term and we wanted to highlight it. Another example, so it would be your average monthly gross earned revenue for each full month you were in operation during 2019, multiplied by 6, or again, capped at 10 million, whichever is less, if your entity didn't start operation till after January 1st, 2019. So basic answer, if you were in operation prior to January 1st, the amount available is the top section. If you're a newer entity that just started operation after January 1st of 19, then you're looking at about your 2019 earned revenue times 6. Again, in either situation, the maximum you would be eligible for is $10 million. At the bottom of the slide here, we have perhaps one of the most important links. It's the links to the FAQ document on the SBA website. Again, great information that's out there. In reality, the FAQs are laid out pretty well, pretty easy to see. So would highly recommend taking a look at those if you have further questions as you're looking at eligibility in your entity.
Annie, if you don't mind, I'm going to interrupt for 1 second.
Sure.
One clarification to the slide, is it gross earned or a gross combination of earned and contributed?
It is gross earned. They actually do have a carve out where contribution revenue would not be included. So that's a good segue to the next slide. They're defining earned revenue as your revenue from various sales of goods and services, admission tickets, food and beverages, advertising, etc. That would not include your fundraising, your contribution type revenue. So it's your gross earned revenue. They then also defined earned revenue. And then there's this big focus on principal business activity. So, if you're a performing theater, it's pretty simple. Okay, your main operation is performing arts. That would be your principal business activity. I think they really wanted to define this. If you had hybrid entities, maybe you had like a shopping center mall where maybe you do have a movie theater in there, but you have other things, really trying to carve it out and say, hey, this grant is intended for performing arts, museums, live art, motion picture studios, things like that, where they've really been affected by the pandemic. So if you operate in many different business segments, they do define the principal business activity, and they're going to want to see, okay, based on employees and hours, what really is your principal activity, and would that qualify you for the shuttered venue? They also got really specific on the museum. Um, it was just kind of interesting. I think they figured, well, live performing arts is pretty straightforward. Movie theater is pretty straightforward, but they went into pretty good detail on a museum. I'll just highlight the third bullet point there. They did specify to be a museum, or under the definition, you'd have to have at least one auditorium, a theater, or a performance hall that has fixed seating. Fixed seating is attached to the floor. I'm not quite sure what the thought process was behind that, but that is a very clear distinction. So if you're, say, a historical house type thing, you have a fixed seating area, maybe where the folks come in and you do a little introduction and you have a seating area and that kind of kicks off your tour. That would be what they would consider, and you'd fall under that museum category. And I'll talk a little bit about that coming up here. So we talked about how much money is available, talked about a couple key terms. For any entity who could be applicable for the shuttered venue, what are some of the requirements? You must have been in operation as of February 29th of 2020, and you're either operating now or planning to operate going forward. There really is no employee number exclusion unless you're operating in more than one country and more than 10 states. So based off talking to Allison, it sounds like probably don't have any entities like that on the discussion today, but that would be your exclusion. The 500 employee type thing relates to operations in more than one country and more than 10 states as of February 29th. So you're going to see this in a couple places in the presentation. Another exclusion or a requirement is your entity must not have received a PPP loan on or after December 27th. As Amy pointed out, that may be changing if this next piece of legislation gets signed today or tomorrow. It sounds like they're going to open that up and not make PPP applications an exclusion or something that would preclude you from applying for the shuttered venue. So I know a lot of the discussions have been now, well, hey, maybe I'm eligible for PPP. I think I'm eligible for shuttered venue, but I know I can't do both. So which one should I do? That may be going away. But again, as of today, you cannot get both a PPP loan after December 27th and also get a shuttered venue grant. We had the question about contributions. Also, you cannot have more than 10% of your 2019 gross revenue from the federal government. They do carve out disaster assistance though. So what they're basically saying is, hey, if you're funded heavily from the federal government, you're not really eligible for this program. You would have to have experienced a 25% reduction in gross earned revenue in at least one quarter in 2020, comparing back to the same quarter in 2019. AKA, do you have proof, do you have revenue numbers that show you've had a significant downturn because of the pandemic? And then I thought this was important to highlight, if nothing else, a little levity during the situation. They do not want you to be engaged in prurient sexual nature activities or derive more than de minimis revenue from such activities. So I guess politely saying, hopefully you don't operate strip clubs. I think that was their intention of nicely saying those entities are not eligible. So I thought at least we'd include a little levity here. I'm guessing none of the folks on the call here today have any such activities, but the government did take time to include that, and I had to look up what prurient meant since that was not a term I was familiar with. So eligible entities would include your live venue operators, your theatrical producers, live performing arts, entities that basically earn 70% of earned revenue from ticket sales and concessions. That seems pretty straightforward. We talked about the museum operators, again, underlined key term, must have fixed seating. And again, they really focus on this is open or intends to open. So if your entity was shut down as a result of the pandemic, you have to be showing a good faith effort to open back up and when your plans are to open back up. They talked about the motion picture theater operators. You have to have at least one space for the purpose of motion picture exhibition where you charge a fee, and you have to be marketing your show times in electronic or printed listings. So typical movie theater, that seems pretty straightforward. And then if you are a talent representative, not less than 70% of your operations are engaged in representing or managing 2 or more artists or entertainers. So they do even have a carve out there for talent representative entities. So this is where things get interesting. So they include different priority tranches for this funding. So if anyone did apply for a PPP-1 loan, it was kind of a race and everyone had to get the applications in, and when did the system open up, and then when were they going to be approved, and then when could you apply for forgiveness? Well, we were hoping they would get that kind of worked out and not turn it into so much a race, but that is not the case for the shuttered venue. So they have different tranches of priorities. We've included that first, second, third. So in the first priority, this would be in the first 14 days, whenever the portal opens, which again, I checked this morning, it was not open as of this morning. It would be priorities for entities that suffered 90% or more revenue loss from April 20th through December of 2020 due to the COVID pandemic. So obviously, based on need, they're going first priority. Second priority, that level is dropped from 90 to 70%. Then third priority, which would be beginning 28 days after your first and second priority awards are made, that would be a 25% loss is where that threshold is. And then you have supplemental funding if entities did get first or second priority rounds and suffered 70% or greater revenue loss for the most recent calendar quarter, which now they're getting into 2021. There's additional funding for that. And then after those priorities, you kind of have 61 days, anyone that suffered 25% or greater revenue loss. So as you're thinking about how does your entity fit in, and where might you fall, or does it make sense to apply for this? Think about your revenue losses and how you compared to the prior to the pandemic times, pre-pandemic, and then during last year. And then that'll tell you kind of where you're probably going to fall in this competitive grant situation. Just listed out here, and this is straight off the SBA website, what you can use these funds for. The list seems to make pretty good sense, right? Your payroll, your rent, your utilities, mortgage payments, your normal operating cost, if you had any leases that were already in effect, insurance, basically anything to keep you in operations and that you have to do to keep your operations running. What can't you use it for? You can't go buying real estate. You can't make payments on new loans. You can't go make new investments or new loans with these funds. Obviously, no political contribution type things, or they left it open to any other prohibited uses. So I included a couple key FAQs here, just further defining, and this is right out of the FAQs on the SBA website. What is an eligible entity? We already talked about some of these, so I just included that more for reference. Some entities have been asking, if we're a wedding or event venue, are we eligible to apply? Thought this was important, so probably not, because again, you're looking into what requirements would you have? Are you selling tickets for wedding or events? Are you promoting your events to a public? The sound mixing equipment, some of that stuff. It's like, well, probably not. That's more a pay for a fee facility rental type thing. Sports stadiums most likely would not be included. Same thing with restaurants, because again, is a restaurant principal business? Is it serving food to customers, or is it some kind of theater? Now, you could get into some mix. I'm thinking like Las Vegas, right, where you do a dinner and a show. Okay, that's one that you may be able to meet that, because is the food really the principal activity, or is the show the principal activity? So there is a little bit of a interpretation on that one. So just again, calling out the 500 employee line here. If you are owned or operated maybe by a government or a college, you could be eligible to apply as well. So I thought that was important to highlight. And then as we talked about, we don't know when the portal is going to open, but our best advice is take a look at some of the criteria, take a look at some of the FAQs. They did just release the application checklist, so that's available out there as well. That's important to see, okay, do you have the information you need for that, and that you could apply so that when the portal opens, you're ready to go. But again, we don't know when that portal is going to open, and it's going to be a little bit of a rush. And as you saw, there's those tiers based on need of where you might fall and when you could apply and how your application will be processed. So last slide for this portion of the presentation, just wanted to cross program consider. How do things fall out here? So as we said, as of today, you cannot apply for PPP2 or get a loan after December 27th. and apply for the shuttered venue. So we've included some of those things here, kind of the if scenario. If you do PPP, can you do shuttered venue? It is pretty open. If anyone got an economic injury disaster loan, you may apply for the EIDL, and PPP you just can't use for the same purpose. And I know Tina is going to cover a little bit about that as well. So this slide holds for now. Again, if the legislation goes through as is and is signed by President Biden, we'll end up in a situation where you can do both the PPP as well as the shuttered venue. And with that, I'll turn it over to Tina to talk about employee retention credits.
So real quick, this is Amy jumping in here. Danny, we have a number of questions in the chat. While we go through Tina's, if you'd want to review those, we'll either answer them through the chat or at the end in our extra Q&A time. With that, Tina, I'll hand it to you.
Thanks, Amy. I'll try to keep this somewhat brief. I know there's been more information probably out there about the employee retention credit than there has been about shuttered venues, but I just want to hopefully leave time at the end for questions. So I'll try to be brief in my remarks as I can be overall. So for those of you who are not familiar with the employee retention credit, it is a refundable tax credit against certain employment taxes. So the credit was originally created under the CARES Act in 2020, and it's recently been modified under the Consolidated Appropriations Act. That is what was passed at the end of December. So some of the changes are retroactive, like those who took a PPP loan in 2020, you're now able to apply for ERC. Other changes, such as the credit amount and the gross receipts decline tests, those are prospective and effective from 1/1/21 to 6/30/21. And so on these next few slides, we're going to talk about what's different between 2020 and 2021. So this slide just basically gives you the overview of what was in place in 2020 and does take into account any changes that would have happened with the CAA changes. So ERC is available to all eligible employers. Those would include your 501c organizations. Your eligibility criteria, so this is an either or, you do not have to do both. So either an organization in 2020 had to suffer a significant decline in gross receipts of 50% or greater, or has to have a full or partial suspension of operations. And we'll talk more about these terms in other slides. This is more just to kind of give you an overview of the lay of how it works. Once you determine if you're eligible or not, you then have to look at your qualified expenses and which ones you can take. And so for 2020, if an organization has greater than 100 full-time employees, then the qualified expenses that are available would be the wages and health plan expenses paid to employees that were not providing services to the organization. So think of furloughed employees where you were paying them, but they weren't working at the time. If an organization has less than 100 full-time employees, then the organization is able to take for qualified expenses those wages and health plan expenses that were paid to all employees, regardless of whether the employee provided services to the organization or not. So slightly more advantageous if you're able to fall under that 100-person threshold. And expenses funded by PPP are not eligible. So I was just commenting yesterday, I feel like one of the new maybe buzzwords for this year is going to be double dipping, because I feel like we've been talking about that a lot lately because of all the interplay between all the different monies that are floating around out there for organizations. And for 2020, your available credit it's 50% of the first $10,000 in qualified wages and healthcare costs that are paid to employees. And the maximum credit is $5,000 per employee for the year. And then this is just kind of a handy dandy little chart that walks you through the process. This particular, the way this one is set up that Plante Moran kind of put together, this one starts off as with the main question of was your business fully or partially suspended due to a governmental order, and then kind of walks you through the decision tree, how you get to whether you apply for the credit or not. I found in conversations with clients, in some cases, where I've started the actual conversation is more talking about their full-time employees and discussing with them, you know, did you have over 100 full-time employees and did you actually pay any of them to not work? That seems to be sometimes in some cases a better starting point, I find, just because then you can almost immediately say, well, we didn't have more than 100 employees, or or we had more than 100 employees, but we didn't pay them not to work, well, then you automatically know you're not applicable for the credit. So while this is helpful, I find that asking the questions in different ways sometimes gets a quicker answer. And then this is the changes that were made out of the Consolidated Appropriations Act and what's effective now for 2021. So it did extend the credit until June 30th, 2021. 501c3s are still eligible employers for this part of the credit. Colleges and universities were also now scoped into the credit for these 2 quarters. The eligibility criteria still similar, except for now your significant decline in gross receipts has dropped from 50% to 20%. And when we talked about the qualified expenses, that 100 full-time employee threshold is now increased to 500. So potentially more advantageous for those smaller organizations. And your available credit is now 70% of the first $10,000 in qualified wages per employee per quarter, which is now a maximum credit of $7,000 per employee per quarter. So the difference from 2020, it was an annual, now it is a quarter by quarter credit. And then again, for 2021, a chart just basically showing you how you walk through the decision points, pretty much very similar to prior year for 2020. And then for those of you that kind of like a nice little chart, I thought we'd put this together and put this in here. So it kind of gives you on a quick glance, what are the differences or the main significant differences. And just what I wanted to highlight here is just kind of looking down at that bottom row where it talks about the 50 employees for the max credit. So let's say you had 50 employees, you'd be under that 100-person threshold for 2020, and you'd be under the 500-person threshold for 2021. So that means that you can take all of the salaries paid to these employees, regardless of whether they worked or not for the organization during that time period. So for 2020, if you had 50 employees and you could maximize the credit for them, the maximum credit would be $250,000. However, if you look at it in 2021, if you have those same 50 employees, now you're talking at a quarter by quarter. So we're now talking about $350,000 for Q1 2021 and $350,000 for Q2 of 2021, or a $700,000 credit. So more advantageous, certainly, as you can see here from those numbers. And yes, with Jackie Chan, you gotta love the memes, but yes, that is a lot of cash that is available. A lot of cash is available for all of these different things that we're talking about, Shuttered Venue, ERTC, and the many other programs that are out there. So to talk about more of the details now that we've kind of talked about the basics, but first thing is, one of the things that has come up is when you look at the information that's out there about the ERTC, there's discussions about aggregated groups. And so for not-for-profits, what that means is that basically if organization A is able to, or sorry, I want to talk about direct first. Direct control would be if you have organization A and organization B, and they have boards that overlap, and that overlap is greater than 80%, then you have potential, you would likely have aggregation. The other type of control that's included in here would be an indirect control, and that would be where organization A basically appoints or removes more than 80% of the board members of organization B. So in those cases where you have this interplay between the two organizations, what you would then need to do is you would need to aggregate the gross receipts between the two organizations, and you'd also need to aggregate the employee numbers between the two organizations to then determine if you're eligible for the credit. And a lot of times when I first get the information from the organization, oh, can you back up? Thanks, Danny. When you look at the information for the organizations, when I get questions from clients, I look to the 990 as a starting point. And so I usually look at the Schedule R that provides the information about related entities to the filing organization. And the only thing to point out though is that for Schedule R, the starting point is 50% control. This requirement here is 80% control. So you just want to keep that in mind when you're using that as a starting point. Then the question is, what are gross receipts for tax exempt organizations? So in the most recent legislation, they basically said that you need to look to section 6033 of the code to determine what the gross receipts are. But basically what that boils down to is the ones that are here. And the key one here is really is the gross proceeds from sales of securities or other assets. So basically, if you were to look at your schedule of revenue on your 990, it would basically be the main line items. So it'd be your contributions, your grants, your program fees, your investment income, which would include your dividends and your interest. You have your rental income and your royalties, so that's the case. Then you have your gross proceeds from your sales of securities or assets. And then you'd have your gross revenues related to fundraising, gaming, and other revenues. So the key takeaway here is really that and if you were to look at your schedule of revenues on your 990, you would have things like rental expenses, fundraising expenses, cost of goods sold. Those would be netted against those numbers, but we don't want to include those when we're doing the gross receipts test. The other things that we don't want to include are your unrealized gains or losses or your donated services or space. Those are things that are not included on the statement of revenues for the 990, and they would not be included in your calculation. And then on the last piece here, when talking about full-time employees, these are not the same thing as full-time equivalents. It's not the same as what you would do for the PPP calculation. What the rules that do apply here, these would be the same rules as the Affordable Care Act. So when you're looking at that information, you want to make sure that you're picking up the right information. And when you look at full-time employees, 2019 is the measurement period for both 2020 and 2021. So when you're determining the 100 full-time employee threshold or the 500 employee threshold, you have to look back to 2019. And what a full-time employee is really, it's a person who has worked at least 30 hours per week or at least 130 hours in a month. And it is a monthly analysis. So you would look at your employees for each of the months. And if they worked 30 hours or more, then they are 1 FTE. If they worked less than that, they are counted as 0. And then what you then do is you take the number of full-time employees for each of the months, you add them up, and then you divide them by 12. And then that will give you your average number that you would then use to determine if you're across the 100-person or the 500-person threshold. And then what I find to be maybe potentially the trickier part of the employer retention credit is really the full or partial suspension of operations that's in place. And that really requires a governmental order. And they recently put out, the IRS recently put out a revenue ruling that talks in more detail about some of these pieces with the governmental order. But what's kind of come out of it is one, really, they gave some more definitions to the teleworking, but in general, if you can do the same work you were doing before, so that'd be like Plante Moran, we are able to do the same work that we were before, only we're doing it now from home. So we really aren't considered suspended based on what we can do. The other thing to point out is that it can't be a voluntary suspension. It has to be due to a governmental order, and the governmental order is either federal, state, or local. So examples of this would be, the closure of non-essential businesses for a specified period, shelter-in-place orders that were in place, curfews, and things of that nature. So things that have come directly down from local, state, or federal government. In this case, talking too about the partial suspension. So if you have an employer that's closed for certain purposes, but open for others, then they could be partially suspended if more than a nominal portion of operations are suspended. And so that nominal piece was not in the legislation, but was in the IRS frequently asked questions. And in the ruling that just came out recently, which is 2021-20, that's the notice that came out, they did put some definitions behind what is nominal. So I've listed those here for your reference. Don't necessarily want to read the whole slide, but just putting that down there so that you know that there is more information about that because it was previously undefined. And really, one of the other things that came out of that notice that they talked about for going back to the teleworking concept is that, do you think you're partially or fully suspended for teleworking if you have adequate IT support? So you have adequate IT support such that people can work from home, then you're probably not suspended. How portable does an employee's work? So of course they give examples of like us, I was saying with us being CPA firm, we can easily move around. We have laptops. That's, we're a service firm. So that's a lot of what we do. Manufacturing, not so portable, not likely you're going to have some sort of suspension. And then it just talked about the need for a presence in the employee's physical workspace. So if it's critical for an employee to be there, then you might have an argument for being shut down or partially suspended versus not. And really, I think the last bullet point is key, is that really interpretation of suspension orders and determining if you're fully or partially shut down. Really, you may want to talk to your legal council about their thoughts on the matter as well. The information that's provided by the IRS frequently asked questions, a lot of them I find are more geared towards retail and manufacturing and may not necessarily discuss situations that we would find in our normal not-for-profit organizations or things related to museums and that nature. So I think it's really is somewhat key to get your legal counsel involved and get their opinions as well to see if you have a strong argument for whether you were partially or fully shut down. And then on this slide, just wanted to talk about the PPP and the ERC interplay. So as I previously mentioned, organizations that took PPP1 are now eligible for ERC. And there is really the potential to fully maximize both the PPP and the ERC. But the biggest concern here is that you don't want to, double dip, again, that term. So you really want to make sure that you are looking at both of these programs like simultaneously to make sure that you have enough to cover both of them. The other thing too that I think some of the questions that have been brought up were, can organizations take ERC during the cover period? And again, yes, you can. But again, it's just making sure that you have enough salaries to cover both the forgiveness of the PPP, which you have to have at least 60% of your expenses are related to salaries, and also make sure you have enough for the ERC. The other concern too, overall with the ERC is also that's interplay with the federal, state, and local grants. So if you're organizations that already get federal monies, then maybe you have single audit done, or maybe even if you don't have a single audit, but still there is the discussion out there that if you are using these federal monies and you have, in order to draw down the grant monies, you're using salaries to do that drawdown, you can't really use that same money then to also then claim the employer retention credit. So this is ultimately like, you could have like 3 different spreadsheets going on of how you're trying to analyze. If you have PPP money, you have this potential for ERC, and then you have the potential with your federal and other grant monies that you have. And I've seen some discussions about, looking at how to take what first. And so obviously I would think you might want to look at your federal monies first and make sure you have enough monies to cover those, to get those monies, because there's no loans or anything associated with them. It's free money, so to speak. Then the next thing you might want to look at then is applying your salaries to your PPP, because again, that's also potentially free money if you can get it 100% forgiven. And then the ERC might be the last piece that you look at, because it really is a partial credit. It's a very advantageous credit, but it still is a partial credit that's out there. So just thinking about those orders in terms of what you're looking at. And the one bullet point here with the PPP loan forgiveness and gross receipts, it's a common question we've seen. I was just on a conference the other day, and the IRS says that they are looking into that currently, if the PPP loan forgiveness and the gross receipts or PPP loan forgiveness should be included in gross receipts. So we're expecting something from the IRS on further clarification in that manner. And then when it goes to claim the ERC, so basically when it comes to claiming it, you either for 2020, since we're past that point now, you would basically do amended 941s. If you are going to do the ERC coming up for 2021, you can actually claim that through your current 941, which will be due, the quarter's going to end here in March, so that would be due in April. And then one of the other things that organizations can do if they are feeling a cash crunch is they can work with their payroll providers to actually retain their deposits. So when we say retain your deposits, that means that would be not only the employer paid Social Security and Medicare, that's also the employee paid Social Security and Medicare, and the employee's tax withholdings. So while the employee would still get credit as if those monies were withheld and then transmitted to the IRS, the organization itself doesn't actually have to do that per the way this credit is set up. So again, looking real quick at some FAQs, and I know that people probably have some questions overall, but some of the common questions were, is ERC taxable to nonprofits? And it would not be. There isn't a taxability portion to this. So there's no UBI component related to this. If your gross receipts, would they be on the cash or the accrual basis? We would say that you would do them based on how your 990 is prepared. So if your 990, on the 990, it actually is a box that's checked if it's accrual or cash basis. So if your 990 is done on an accrual basis, you would want to do your calculation on an accrual basis. And then for PPP, there is the $100,000 cap on the salaries, but for ERC, there really isn't a cap per se. It's just more, you have to look at in the quarter for 2021, you have to look at for the quarter basis, when do you hit the $10,000 limit? And then at the bottom there, I do have a link to the frequently asked questions that are on the IRS website. They're very helpful. There's about 90 of them. And then when you actually go on the site itself, right above it, it'll tell you that there is guidance that's out. And so the guidance that'll take you, it's a link to the 2021-20 notice that just came out. Again, that notice is only for 2020 2020 ERC. They have not yet issued guidance related to the 2021 ERC. So we're still expecting that to come out as well. And then here, I think it's just really a list of our next steps and key takeaways. I'll finish up the slide here, but really for the Shuttered Venue Grant, you want to make sure you review your checklist to see if you qualify and estimate the potential dollars for which you're eligible for, because as Danny said, we expect that the portal is going to open at any time. So you really just want to be ready when that does open up. For ERC, I think the key here is you want organizations that receive PPP are now eligible for ERC. You want to make sure you review your eligibility requirements, as the credit can be large, but at the same time, keeping in mind that there is that interplay between the different federal fundings, state fundings, PPP, just make sure you're not double dipping. You really want to also think about PPP2. Although we didn't talk about it today, I don't have time because you could talk for hours, I feel like, on each of these subjects, but this could be an option that is available for you as well. But just remember that right now, as it is written, PPP2 will disqualify you from the Shuttered Venue Grant, but however, could change by Wednesday, we never know. And the other thing I did forget about real quick, and I got it in my notes here, but Amy had mentioned I was going to talk about it, but so in the bill, the changes that are going to happen for ERC is that they would extend it to third and fourth quarter. That's what the plan is. And then what they're going to say is that all wages are eligible if gross receipts drop below 90%, regardless of your employee count. So you'll no longer have those thresholds. For businesses that began after 2/15/20 with less than $1 million in average gross receipts for the prior 3 years, and for which it is not otherwise eligible for the ERC, they will now be eligible for the ERC, but there's going to be a cap at $50,000 in total for a quarter. And then it's also going to create a 5-year statute of limitations on the credit. And then it makes clear that the employer is who is responsible for the credit, not the payroll company itself. The payroll company is just there to help you facilitate the credits and potentially help you with your 941s, but they aren't there to, they aren't responsible in case the IRS came back and were to come back on someone, they would come back on the employer, not on the payroll company. So, and then just at the bottom of the page here for other resources, just to point out to you that we have, Plante Moran has several different areas where you can look for different information, not only on COVID-19, which is the bottom piece, the CARES Act, but then the top link there is also a link to things specific on the employee retention credit. We did just do another webinar last week that was an hour long. So even in more detail than what I've, trying to briefly do this, but so those are links that we wanted to provide to you just in case you have further questions or wanted to do additional reading on this subject. And I will now hand it back to Amy to see what's come through on our chats.
Lots of things have come through on chat. So thank you everyone who have put in their questions. And I think with the number of questions, we won't be able to get through them all. So we might have a FAQ follow-up that we'll give Allison to post, as well as our slides will be provided too. I think we'll start with the Shuttered Venue questions. So Danny, there were some questions still trying to clarify between Shuttered Venue and talking about gross earned in the inclusion of contributed. That came up a few times. So can you just go over that one more time on what is gross earned and how contributions work into that?
Yeah, excellent, Amy. Yeah, sorry, with the screen sharing, I wasn't sure how to work the chat thing, so
we'll definitely my bad. I noticed that, yeah.
Yep, no, it's all good, it's all good. Yes, so there's actually an FAQ for this. So it says, does a nonprofit count contributions and grants revenue? says no, contributions and grants revenue are excluded from an organization's earned revenue. So the SBA says it will take into account any federal grant revenue to determine if you met that 10% threshold there. But again, when they're looking at gross earned revenue, that's going to be your ticket sales, your admissions, food and beverages, all of that is considered gross earned revenue. You are not including any of those contributions or donations from members or outside parties as part of that calculation.
Perfect. There was one question I think I found in the FAQ, and so I responded. The question was 2019 calendar year, fiscal year. It looked like the FAQs specified that it's fiscal year. So I believe that answers that next question. This one's kind of interesting. So if there's multiple venues, one with fixed seating and one without, then do they need to bifurcate the activities or revenues tied between the venues, or do they look at it as a whole? That one might be one we have to follow up on. Or have you seen that one addressed?
That one, I don't know that one right off the top of my head. I know there is an FAQ that talks about the seating, kind of if you had two theaters, but one's really being used and one isn't. I can take a look at that one. That one might have to get back, but I know they did address, I think you're looking at in the totality, again, principal business operations. So I think as long as you meet the criteria and you have fixed seating and say you have a museum and maybe have two theaters, but you have one and it's got the fixed seating, I think you're okay there unless you had separate legal entities that maybe one has a theater, another one has the fixed seating. Then you're getting into different considerations if they're separate legal entities. But if it's one entity and you have multiple theaters, I think as long as you meet the criteria, you've met the criteria.
And so I think then for those in that situation, if they're all operating under one federal identification number, one EIN, then you would group together. If it's more than one, then the further questions arise. So separate legal entities, that's how you can think through that piece of it. One of the questions was number of fixed seating you have to have. I looked in the FAQ, I did respond that I don't believe there's a fixed number, but they do define what is a fixed seat. So I did copy that FAQ and put that in the chat for those individuals. Did you have any?
Yeah, they didn't specify. I think as long as you have the fixed seating, again, they're not looking at numbers of those. As long as you are a qualifying entity that does have the fixed seating, again, fixed seating is most important for the museum classification, then you're okay. They do have an FAQ that talks about if you're thinking like high school gyms where you have those roll out, push out bleachers and that, if it's considered cumbersome, attached, fixed, that would count as well. So, I mean, you're not just thinking seats that are screwed into the ground. It could be some other things. Again, you have the fixed seating part for venues, and obviously if you have a theater, you're going to have the fixed seating, but they really hone in on it for the museum portion.
All right, perfect. And then at some point, we can maybe do this after the FAQ. We'll post what the portal website is. There's a question on what that link was. There was also a question about a combo of performance space plus rental of that space. Did the FAQs address a rental scenario at this time, or is that still outstanding?
Yeah, that one, and I thought I saw another one that included, you know, what if you had a sale of real estate, is that gross earned in that? So I don't recall in looking through the FAQs if they got quite into that portion about fixed versus rental. Again, it went into principal business activity. And if you have a theater and you have the seating and maybe you do rent it out at a part of the time, but other time you have tickets that people are purchasing for that space, you know, again, there's a distinction for the movie theaters. I think you probably would fall in, but I would definitely recommend, depending on how much your rental income is versus how much is normal, say, income of the operations, that the SBA may use that as a determining factor to say, well, are you really a museum operating or a theater operating, or really you're just generating rental income and then you don't meet those other criteria?
Okay, perfect. I've got one more for you, and then I'll switch over and talk to Tina, and maybe you can post the portal website. So the last one that I have is just, again, another clarification for the priority levels. That's based on earned revenue, so not including contributions. Is that correct?
That is correct. Yes,
Okay.
those tiers are based on your gross earned and the drop in those receipts, with the highest level being 90%.
All right, perfect. So I think I covered most of the shuttered venue. If for whatever reason I accidentally overlooked one, or you anyone in the audience comes up with another question, please reach out to us. Again, we're going to post our slides. We'll give those to Allison as well, so you have our information. So Danny, I'm going to let you off the hook for the moment. If you could post that poor website. And then Tina, got some questions for you. Does ERC affect the W-2? So after filing 2020 ERC in 2021, should we revise the W-2?
No, it would not affect the W-2. So as mentioned, even though an organization is, if it's for cash purposes, so if you're withholding your tax deposits, the IRS is still acting as though you've made those deposits for purposes of the employee. So there would not be any modification to the W-2 needed. This only affects your 941 filings for the organization.
Perfect. Does ERC apply if you're with OPERS, the OPERS versus FICA?
I have to look into the OPERS piece, but the way I understand it is that this is a credit for organizations that pay FICA. So I know I was reading that, like, if, let's say this isn't the case here, but if you're a religious organization and some of the interactions are with like priests and pastors and things and how they make payments there and their relationship, then they can't necessarily include those individuals as part of the count because they don't pay FICA for their wages. So I'd have to look at that into the OPERS piece and how that plays in.
All right, perfect. Is it just the taxes paid that are refunded, or all taxes, wages, and benefits?
So it would be your withholdings. So it would be like, so for instance, out of an employee's paycheck, you have to pay, the federal tax withholding, you have to remit that on their behalf. So you would be able to withhold that. And then it would be the FICA and the Medicare, both employer and employee shares that you can withhold from your deposits. And your payroll provider, I think this is kind of their second go around. They've gone through it with 2020. So hopefully they would be familiar with this program now and would be able to help you with that.
All right, perfect. This one might be a blended question. Does ERC prohibit application for the shuttered venue? My understanding is for PPP, you can have both ERC and PPP, but how does shuttered venue work with ERC? Is there a restriction there?
There is no restriction for shuttered venue in ERC.
Perfect.
The only thing that you have to watch out for is how many pools you can, how far can you spread your cash for your salaries is basically, how much salaries do you have and how far can you spread them? So that's probably the biggest, piece that you have to look into for that.
Okay. We had a question on here too, just clarifying PPP2 and shuttered venue eligibility. So right now, and correct me if I'm wrong here, you cannot have both, except in our legislation that is getting reviewed by the House right now, and hopefully voted in and signed by Biden, hopefully by the end of the week, that changes that where you could have both shuttered venue and PPP. Is that correct? Should we clarify?
Yeah, that is correct. So like you said, Amy, you cannot get the PPP2, the one that came after December 27th, and as of now be eligible for the shuttered venue. It's an either or at this point. Okay. Assuming that legislation goes through on Wednesday, the way it's currently written, that would expand it. And I think to your point, as you indicated, they're really opening up a lot of the restrictions with this new legislation, trying to open the pool and avoid some of the either or type things. Because I know we've talked to several not-for-profits and they've gotten confused on it with, which one should I do? How do I make the decision? I can do an either or, and then you get into this cost benefit analysis and what you think your probability is. So I think they're trying to eliminate that and say, hey, we want to exclude certain entities, but in the whole, we want to try to make this as helpful as possible to these smaller venues and these venues that have been suffering.
Okay, perfect. So I'm scanning through. I think I've tackled the ERC. So I think, Tina, you're off the hook for the moment. And we've really only got 2 minutes left. So I think maybe what we'll do is, Danny, can you share your screen again and just have our contact information up? So, those that question maybe wasn't fully addressed or had a follow-up item can write down that information. And again, we'll post the slides. We'll provide those to Allison. Feel free to follow up with us. Again, if you don't want to be contacted after the webinar, because there's all kinds of alerts and so forth that we can keep you updated on. Please let Allison or I know, and we'll remove you from that list. And I think let me pull up the chat because we might have time for one more.
Yeah, Amy, I think just the big picture and what we wanted to communicate today is there's a lot of programs out there. There's things that you certainly can be eligible for, and we wanted you to be aware. It seems like most people don't know as much about the employee retention credit. The Shuttered venue seems to have a lot of different tiers and tranches. So just trying to understand the interplay, because we know it's been just a really tough year for nonprofit organizations, and that there's help out there, but sometimes coming through all the guidance, it's just a lot to digest, and it's changing and quick.
One final clarification, Danny, in our final few seconds here. I just want to make sure, because this one's come up multiple times. For clarification, did you state that the priority period is based on gross earned revenue, or is it gross revenues?
It says gross revenues in the list, and they do make a distinction in the FAQs, gross earned versus gross revenues. It's more clearly defined in the FAQs. But it's technically gross revenue. So again, you're still looking at the revenue off the top. But that I do not believe that would include your contributions and things. Again, they're trying to carve out that piece, is my understanding.
If I can just jump in. Sorry, this is Sean Watterson. I'm with the Happy Dog up in Cleveland. In the priority period, they do want gross revenue, and that does include contributed. Because the intent with that priority period is for those whose total revenues are down 90% and 70%. And I know there's been a lot of confusion with this, especially coming from Americans for the Arts, but for the priority period, the intent is gross revenue, and that does include contributions. For the amount of the grant, it is gross earned revenue. So sorry to jump in on that.
I appreciate that, Sean. I know that has been an area of confusion. So no, I appreciate that clarification, and definitely appreciate you jumping in there.
Sure.
Well, with that, we're now a minute over. So thank you everyone for joining. We really appreciate it. Again, we'll post the slides. Please reach out if you have any questions. Thank you for having us today.
Thank you, everyone.